Hey, it's Nathan with options4l.com. In this video, we're going to talk about trading cash secured puts on Robinhood. Now we're going to go over what a cash secured put is, and then we'll go over to Robinhood and I'll show you how to actually do that particular trade, and then I'll show you how to do it on Robinhood Legend. So let's go ahead and get into it. So here we are on our options cheat sheet, and we're on the strategies tab, and we're looking at the cash secured puts. So cash secured put, it's a credit trade, so you're going to receive a credit up front for this type of trade. Now your bias is bullish, so you think that the stock is going to go up, and that's why you would go ahead and do a cash secured put. Or at the very least, you think that the stock is going to stay relatively neutral or flat. You don't want the stock to go down in this particular trade. So to open this trade, you're just simply selling to open one put at a strike price, and if you want to close the trade early, you just buy back that put. So buy to close one put at that strike price. So that's what we're doing in this video. So what is a cash secured put? Well, it's a strategy where you sell a put option and you set aside enough cash to buy the stock at the strike price if you're assigned. Hence the word cash secured put. You have the cash available, it's set aside and ready and waiting to buy the stock if the option gets exercised. So you're basically saying, I'm willing to buy this stock at a lower price and I'll get paid at a premium while I wait. So what's happening conceptually, you choose a stock you'd be okay with owning. So you don't want to necessarily do this if you don't want to own the stock anyway, because if the trade doesn't go in your favor, you're going to have to buy that stock. And if you didn't actually want that stock or to hold that stock for the long term, you probably don't want to do this particular trade. So you choose a strike price where you're comfortable buying that stock. You sell a put at that strike price and receive a premium. You keep enough cash in your account to buy 100 shares at that strike. That's why it's called cash secured. You have the cash already. And it's for a stock that you don't mind owning anyway. So you might buy 100 shares of a stock that you don't mind owning, and you might buy it at a lower price than it currently is today when you sell your cash secured put. So if the stock falls below the strike and the option is exercised, you have to buy it. You're obligated to buy it. You have to buy those shares. And if it stays above the strike, the option will expire worthless and you get to keep the cash and the premium. So you don't have to use your cash in your account, and you get to keep that premium that you got for selling the put option in the first place. So basic setup with numbers. So imagine the stock price right now is $100. You sell one put option with a strike price of $95, so it's below the current price of the stock. Expiration is 1 month out. Premium received is $4 per share. So each option contract is 100 shares. So premium received is 4 because it's $4 per share times 100 shares equals $400 premium. And so to make the put cash secured, you need to have cash on hand. So if you're assigned, you have to have 95 times 100 shares. So $9,500 cash in your account to go ahead and do this trade. So at the start, you receive $400. And you have to have $9,500 in cash ready in case you must buy the shares. So what happens at expiration? Now this is what happens at expiration. There are different actions you could go ahead and take prior to expiration, like you could go ahead and roll your position down and out, so to a lower strike price at a further out expiration date. Additionally, you could go ahead and buy back your put options. Now you probably will lose money in the process, but if the stock is tanking or something like that, it might be better just close out and cut your losses, so that way you're not having to buy a stock like at $95 strike price when it's dropping like rapidly. Maybe it's going to zero. And so you want to get out as soon as possible. So you might need to buy back your put options in order to close it out. So let's go through a couple examples. And again, this is at expiration. So stock stays above the strike price of $95. So for example, stock is $100, $103, $120 at expiration. The buyer of the put option has a right to sell at $95. But if the market's above $95, it doesn't make any sense for them to sell their shares to you for $95 a piece when they could go to the market and sell it to somebody else for $100 a piece or $103 or $120 a piece. They're not going to sell for less than what they can get on the open market, so the option would then expire worthless. And so you get to keep your entire $400 premium, plus you get to keep the $9,500 cash in your account. And so the total result is a profit of $400. No stock position is created, and so that's the best case outcome for this particular trade. So again, this is a bullish trade. You think that the stock is going to go up, so that way you can collect that premium and not have to buy 100 shares of the stock. Now in the next example, the stock finishes below the strike price. So example, the stock ends at $90. So the put buyer has the right to sell it at $95, which is better than the market price of $90. So they're going to exercise their option, and you have to go ahead and buy the shares from them at the strike price, which is $95. So they exercise the put, you are assigned, and you must buy 100 shares at $95. You're obligated to do it. And so you have to do it. And this happens automatically in your account. You won't have any say in the process. They're just going to sell you 100 shares for $95 a pop, so $9,500. So cash flow at assignment, you spend $9,500 to buy 100 shares at $95. You already received the $400 in premium earlier, so that doesn't go away. You still have that $400. Your effective net cost then is the $9,500 divided by $400 credit premium you received divided by 100 for 100 shares, so $91 per share. And so if the stock is at $90, your shares are worth 100 times 90 because you had to buy all 100 shares. And you bought them at $95 a pop, but now they're worth $90. So your assets that you're holding is $9,000. You effectively paid $9,100 after subtracting the premium out. So you're down a total of $100. So at $90, your net loss is $100. Now the break-even price. So break-even accounts for the premium you received for a cash secured put. The break-even price equals the strike price minus the premium received. So let's do this with some numbers. So the strike is $95. We received a $4 premium. 95 minus 4 is the $91 that we just came up with over here. So basically at expiration, at the stock price is $91. Your net result is 0. Above 91, you see profit. Below 91, you lose. Just like we had in the example up above, the stock went to 90. We had spent 91, so we lost $100 because we lost $1 per share. Times 100 shares is $100. So one other example, check at 91, you're assigned and buy at 95, so you spent $9,500. The stock is worth $91, so your account, you have $9,100 worth of stock in your account. You lose $400 of value on the stock because $9,500 minus $9,100 is $400, but you did make the $400 on the premium, which you get to keep no matter what, so your net is 0. And that's how you get to the break-even value right there. So risk and reward profile, maximum profit. Your best possible outcome is to keep the premium with no assignment. So max profit per share equals the premium received. With one contract, we have $400 max profit in this particular example that we've been going through. So this happens when the stock finishes at or above the strike at expiration. Now maximum loss. So this is the worst case, is the stock going all the way to $0. And so if this happens, you're assigned and buy the stock at $95 per share, so $9,500 cash. Stock goes to 0. Your shares are worth 0. You get to keep the $400. So, you're not completely out, but your net loss is $9,500 minus $400, $9,100. So that's if the stock completely tanks down to 0. Again, there are some different defensive strategies you could take. Like if you see it going down, you could go ahead and buy back your put option. It will probably cost you money. You'll probably lose some money, but you won't lose, the full $9,100. Or maybe it's just a slight pullback and you just need to roll out your position to a later expiration date and down to a lower strike price. And oftentimes you can roll for a credit. So it might not be the worst case scenario. So the max loss per share is the strike minus the premium. And the summary of the profile, so upside, we have limited to the premium. So the max we're going to make is the $400 premium that we collected. Downside is large, so if the stock drops a lot and you have to buy the stock at a price higher than it currently is, well then you're going to lose some money on that position. But if you already planned on the possibility of owning the shares anyway, maybe it's not the worst thing in the world. Yeah, it went lower than you were hoping, but hopefully you bought a stock that you actually do want to own and that you could hold on to for a longer period of time. And hopefully the market turns around for you and ultimately you wind up making money. So that's why it's key to pick stocks that you actually want to own when doing this strategy, because there is a chance that you do have to buy, 100 shares of that particular stock. And if it's like a garbage stock and you're just trying to make a quick buck, well, you could really get messed up. So why use a cash secured put? Some common reasons. You get paid to try and buy a stock at a cheaper price. So you're happy to own the stock at the lower price. You collect premium while waiting. If assigned, you own the shares at an effective discount, so strike minus the premium. So in our particular example, the stock was at $100 when we sold our put option, and we sold it at a $95 strike, and we collected a $4 premium. So in a way, we're saying that we will buy the stock at $91 per share. Now you can also generate income with cash. So instead of just letting your cash sit there, you sell puts on stocks that you like. And if it's not assigned, you get to keep the premium as income. So you've got your cash there, you can do the cash secured puts, selling the puts, collecting the premium, and then you're making some money on your cash that's just sitting there. Now you do need a defined plan, so you pre-decide, I'm willing to buy this stock at this price. Again, that's the key. That's the thing you have to understand and decide. Like, am I willing to own this stock for the long haul? And so the intuition in plain language, a cash secured put is like placing a limit buy order at a lower price, but getting paid for willing to buy. So if the stock doesn't fall to your level, you keep the cash plus the premium. If the stock does fall, you end up owning it at a discount, so the strike minus the premium, but you also take on the risk of further declines, again, because you're basically long the stock at that point because you own the 100 shares, and you're along for the ride if it goes down or if it goes up. Of course, there's ways to go ahead and exit that position as well, like you could go ahead and sell the shares immediately and just take your loss, or you could start up the wheel strategy and start selling covered calls against that position. And I'll have another video on the wheel strategy, but that's the explanation of selling cash secured puts. Let's go over to Robinhood and I'll show you how to do this trade. So here we're on Robinhood, and we'll just come up to the search and we'll go for the SPY ETF, and we want to sell a cash secured put against SPY. So again, you need to make sure that you have enough cash in your account to cover the cash secured put. But assuming you do, you come over to trade options, in this case trade SPY options. And what we're doing now is we are selling, and we are selling a put, and then we can go ahead and select our expiration date. I want to do it 30 days out or 31 days out, December 12th. And I want to look for out of the money options to go ahead and trade. So that way I can take on a little less risk. So the current share price is $6.79. So let's come up to the break even or the current share price. And so I'm going to look for a strike price lower than the current price. And usually I'll look at the deltas and I'll go for like a 0.2 delta. So let's scroll on down to 0.2. Go in. There we go. We got a strike price of $6.55, so about $20 less than the current price. We got a 0.2 delta, 81.54% chance of profit, and we can see our bid price right here of $4.25 times 100, so $425 credit is what we will collect here. Now, as long as the price stays above our $655, I'll go ahead and keep that $425, but if it drops below $655, well then, I will have to buy 100 shares of SPY at $655 per share. So let's go ahead and add this to our order so we can see what loads up here. So we're doing a short put, and we can see our total credit right here is $4.25 per share. And you need to make sure that you have enough buying power available to do this trade, which I do at this particular time. And we have this nice little chart right here. We can see as long as it stays above our strike price is $655, like we're going to keep the full premium, the full $425. If it drops below the strike price of $655 minus a premium collected, which is $425, is how we get our break-even price of the $650.75. And you can also see it down here, $650.75. So anything above that, we get to make money. Anything below that, we're buying the shares and we're along for the ride unless we liquidate those shares like immediately. But the max loss, if SPY dropped to $0, we would lose $65,053. But that's like worst case scenario if it drops to 0. And so let's go over to Robinhood Legend real quick, and I'll show you how to conduct this trade over here. So we have our options chain loaded up, and I'm at 31 days out, so December 12th. We want to be on the put side because we're selling cash secured puts, and we want to go below our strike price. And let me load SPY in here instead of IBIT. So we'll load SPY in there, December 12th. And let's scroll on down. Again, we want to go to an out of the money put option. So we were coming down lower than the current price of the stock. So we'll come on down. Again, I like looking for a 0.2 delta or so. So we'll keep scrolling. There we go. We got a 0.21 delta. We are selling. So we're going to do the bid side, or we're shorting. We have the 655 call. And we can see our sell to open order. All right, so limit order, we can select our quantity, we can select our limit price and time in force, and then we can sell our put. And you can see right here it shows the collateral required, so the 65,500 the strike price. So it drops below $655, we're going to have to buy 100 shares of the stock at $655, no matter what the price is. So if it's $650, we still have to buy it at $655. If it drops to $0, we still have to buy it at $655 per share. But also at this moment in time, we have a chance of profit on the short side of an 81.1% chance of this trade going in our favor. So this could be a good trade, especially if we are willing to own SPY anyway. And as a reminder, there are different defensive strategies you could go ahead and employ should the stock, start dropping. If it drops to like 640, but we still have 20 days left till expiration, we might want to roll our position out to a later expiration date and down to a lower strike price, or maybe we just buy back our put options and we get out of that trade, so that way we're not buying 100 shares of SPY at $655 when we can only sell it for $640. And so that's it for this video on selling cash secured puts. Hope you found it helpful. If you did, I appreciate any sorts of likes, comments, subscribes, anything like that, and I hope you have a great rest of the day.